A new year, new investment goals. And like everyone, I'm grappling with news that could shape my investment decisions. The US Fed has paused rate hikes. What does it mean? Is a recession coming? And more importantly, am I doing the right kind of research? Or am I also sabotaging my own decisions based upon what I've chosen to read? So to find out how I'm making my investment decisions, I'm going to try a little experiment.
Let's take a scenario. You've got $10,000 as a bonus, and now you're thinking about investing your $10,000. And you have two choices being given to you. Choice one is a low risk, almost a fixed deposit, which is giving you only 2.5%. And then there is a choice two, which is a high risk investment opportunity, where you have 50% chance of making 30% return and 50% chance of losing 5%. So these two, which would you choose?
There's a lot of uncertainty right now. Things are kind of up in the air. I would tend to think low risk, option one.
Got it. So you're going for choice one.
For now.
Okay. I will now show you 6 headlines. And so imagine in your email inbox these 6 headlines pop up. Which 3 of these 6 would you click to read?
I like the rate hikes one because we've had so much of this throughout the financial year, right? That one pops out to me. The World Bank saying that Asia continues to fuel growth.
Yeah.
That's always good for investors, isn't it? How about the Goldman Sachs one, revising the S&P forecast upwards in 2024? That's good news.
Perfect. So you have chosen the 3. So just, for you to know, behind this there is actually a scoring mechanism, and each of these headlines has a score, a +1 or a -1.
Did I pass?
And you have chosen all 3 as the +1 or the positive news. And so you've picked your score is +3 in this exercise. Now, if I give this choice back to you in terms of the decision, would you consider changing this decision after having seen these headlines?
There's some good news coming down the pike, according to those headlines, in a way. So if I look at that option 2 again, 50% chance of making 30% or 50% chance of losing 5%, with all of that positive news, I could make a revision.
Okay, so you're moving from choice 1 to choice 2.
I mean, in the presence of now, you've given me more information, or rather it popped out to me. Is that an example of
Yes. So what we have just witnessed in this very small experiment is that confirmation bias is manifested when you look at a certain news or a piece of information and you're seeking for more information that agrees with your views. And in this particular case, you have allowed for new information to come and change your view. So that's the confirmation bias in action.
Confirmation bias, when we seek information that confirms our beliefs and ignore what contradicts our beliefs. When given new information, you've got to be able to maybe calibrate a little bit.
And that's the biggest challenge in today's day and age because of social media and algorithms. And so to overcome that, it becomes very important to allow ideas and information which does not agree with your view to still reach you so that you can process it and incorporate in your decision.
If you can drill it down for us, Swapnil, what are the top 3 things that investors ought to look out for in 2024?
First is to really watch the developments from Fed point of view. It's important to see how they are calibrating the pause and whether the pause is really going to remain a pause. Second is the earnings outcome. So if the corporate earnings demonstrate that they have been able to weather the high interest rate in 2023, then it gives us confidence for earnings projections for 2024. We may see upwards of 5 or 6%. If they don't, then that's not good news for equity market, and one has to watch which equities you're holding and what percentage allocation you're making to the equities.
And what about you with strategy? What event might trigger you to change your strategy?
So strong earnings and a clear signal from Fed that they will continue the pause for longer, or they will start cutting, as in clear signal. Clarity from them is a sign which is increased equity because you can take on more risk. If earnings are poor, that's a cause of concern. You have to focus on quality. So then You have to leave mid cap, small cap, and start thinking of good quality if the earnings is poor. If Fed is pedaling back on their pause and rate cuts, then that's again a danger. And cash becomes important in these cases. So actually the asset class which is the most important, I feel, in a portfolio is cash, because that is what you calibrate low and high and deploy or don't deploy.
What might influence a person's decision on just how much cash to hold, though?
In case of 2024, the fixed income opportunity is good, so some cash component should go down. So you don't need to hold 50% cash. 30 to 20% cash I would still hold for my fixed income portion.
Swapnil, if you had to distill your own investment strategy for 2024 into 2 words, that's all you've got, what would you say it is?
Tactical investing. This year there is an opportunity to build your strategic portfolio with a long-term focus using these tactical moments where you'll get the opportunity to add. And I would want to be on top of it and aware of it and build that portfolio.
Tactical investing like this is one way in which investors can find opportunities when markets are volatile. Investors also need to keep the big picture in mind.
I think the key things that investors should remember in 2024 is, number one, do not be too negative. I think if you look at 2024, inflation is coming down, interest rates are going to be cut, and historically, if you cast your mind back to what's happened to the US economy in similar periods like this, you find that the stock markets and bond markets have done very, very well. I think the second factor is that investors, while they are prepared, while they should take risks, they should also not be completely complacent. They should not assume that it's going to be a smooth ride and the outlook is going to be a one-way track. I think the next 12 months, you'll see ups and downs in the market, bruises and bumps. It'll be a bumpy ride. In terms of the geopolitical front, lots of elections in the world taking place in 2024, including the US elections, which is going to be the key focus for the markets. And so, again, these elections could spring surprises and create quite a bit of volatility in the markets, which means that investors should not let their guard down completely. They should really take a more guarded approach in investing in the markets. And that means, practicing dollar cost averaging, time diversification, spreading the investments out over time.